All right. Hi, everybody. Welcome to the presentation today, YouTube Live. Thank you so much for joining me. We'll just give it a minute for another couple people to join. There's a slight delay on the chat, so Wilson, if you can let me know that everything sort of sounds good and it looks good, I always really appreciate that heads up. Apologies, there is a little bit of background noise. I'm at the Center for Social Innovation. Apparently, some of the presentations or events have started up a little bit. So I'm told that everyone's leaving. Apparently, they've got dinner. I was told they'd be gone ahead of time, but we'll just kind of deal with that background noise for now. And my apologies for that. Might have to find a better time to stream rather than 7 p.m. on a Thursday. I feel like everyone's kind of having a good time tonight. Anyway, thank you so much for joining me. It means the world to me that you would choose to spend part of your Thursday with me. So just very, very grateful. What I have on deck for you today is to do my presentation. What is sustainable investing and why does it matter? I've been giving these presentations for probably about a decade now. And it's been a couple of years since I've done this presentation. That really during COVID, there just really haven't been that many opportunities. We aren't sort of throwing big events, or I'm not getting invited to do lunch and learns or anything like that. So, if anyone does have a group that they want to speak to, if you're part of a nonprofit or an organization or a company that is sort of aligned with sustainable investing and you think that people would benefit from that, just know that I'm open to doing these types of digital webinars and would love to be able to present in front of your group. So I'm just kind of going to jump into it. My expectation is that this presentation is probably going to be about, roughly about 30 minutes if I stick to my schedule of a minute per slide. That said, it's my first time doing it. So part of this is to kind of hit the clock and see how we do with it. Certainly, if you've got any questions, by all means, throw them in the chat whenever you want. And at the end of the presentation, that's when I'll take a look at the chat and I can kind of go through and answer your questions that I do think there'll be time for a Q&A after the fact. So I'm just going to jump into the presentation and let's have some fun with it. So what is sustainable investing? Why does it matter? This is sort of my stock presentation. Really excited. Before I jump into the presentation, I will take the opportunity to introduce myself, just because so many people don't know who I am. That my name is Tim Nash. I've been in the sustainable investment space for well over a decade now. My background is that I grew up in London, Ontario, with my dad in the investment industry. From there, I studied economics and philosophy at Dalhousie University. I graduated with a lot more questions about our economic system than I had answers. It was just clear to me that the economic system was not working for everyone, certainly wasn't working for our planet. So I went to Sweden and I did my master's in sustainability. That's why I learned systems thinking and engineering for a sustainable society about all these cool green technologies. And I did my thesis focus on the topic of responsible investing. Really, we were looking at this idea of financial materiality, showing people that you can actually make money, that sustainable investing makes sense, as well as being the right thing to do. It's also the smart thing to do. Came back to Toronto in July of 2008, straight into the crash of the big sort of crash in 2008, and started my own business. Really, there weren't any jobs in the sustainable investment industry back then. It was just very, very small. So I started my own business. You can see me here debating Kevin O'Leary on the old Lang and O'Leary exchange on CBC. So, I've really been doing this for well over a decade now, and I'm really excited to be able to share all of my knowledge and experience with you. So when it comes to a traditional investment portfolio, a lot of people are going to know this, but if you don't know this, when it comes to investing 101, what is a traditional portfolio? It's basically a pie chart. And you can see here, this is a very standard sort of balanced fund pie chart where you're going to have the biggest slice is going to be Canadian bonds, sort of 40% bonds, and the remaining 60% is stocks. And it's going to be split up between Canadian stocks, US stocks, and international stocks. They're not always exactly even like this, but a standard portfolio is going to be a pie chart very, very similar to this. Now, what we're doing with sustainable investing is a little bit different. That really, when I looked at this type of traditional portfolio, really it's a problem, because when you open it up and you look at what's actually in there, unless they specify that these things are excluded, that a traditional portfolio often will include all kinds of things that a sustainable investor doesn't want to touch with a 10-foot pole. Things like weapons, tobacco companies, fossil fuels, pipelines, gold mining companies that, a lot of them have a really bad track record when it comes to human rights abuses, that, all these companies are going to be in a standard portfolio, right? It depends on your portfolio. It doesn't mean that every single one is going to have all of these, but most of them will at some time or another. And certainly they could, that at any given point, unless you want to be looking up the companies and, month to month, that you kind of have to assume that some of this stuff is going to get inside of a traditional portfolio. So, really with a sustainable portfolio, we're doing something a little bit different. It's similar, right? Very similar in terms of this pie chart, but we're doing it a little bit differently. That, most of the portfolio is going to be this mix of doing less evil stocks and bonds. So where we're going to have this kind of standard, large global companies that are in there, but we're getting rid of the worst of the worst. And I'll explain that in a couple minutes. As well, you can see we've carved out part of the pie chart for green stocks, which to me is really cool. This is a way to be able to invest in things that will benefit as the economy transitions to a green economy. And then we also have part of the portfolio carved out for impact bonds. And this is what I get really excited about. And, I'm going to share with you really what each of these sections looks like. So when it comes to the doing less evil approach, there are 3 different tactics that we use in terms of this doing less evil. The first one is called negative screens. This is also known as divestment, or sometimes we talk about exclusions. So what we're doing is we're excluding these quote unquote sin stocks. Now, every fund is going to have a different definition and a different list of what things they exclude, right? Not all of them are going to exclude fossil fuels, but a lot of them do now, right? So it's important to understand, okay, what are those negative screens? This is where we're saying not 1 penny into those specific companies. From there, we have this tactic, which is ESG, environmental, social, and governance analysis. This is where analysts, the portfolio managers, are still looking at financial decisions. They're still looking at the financial data, but they're also looking at this ESG data, looking at things like carbon emissions, how well the company treats employees. And governance, is there a division between the CEO and the chairman of the board, right? The board is supposed to hire and fire that CEO. So if the CEO is also the chair of the board, I'm looking at you, Mark Zuckerberg, then the board is never going to fire that CEO, which can be a little bit of a problem. So lots of different indicators. That's one example, but when we look at ESG, these indicators, there are a whole bunch of different environmental, social, and governance criteria that the managers are looking at in addition to those financial metrics. The last strategy that's used is this idea of shareholder activism. This is the notion that when you own shares in a company, even if it's inside a fund, you still own all those different shares of all those different companies. You're allowed to push those companies in a more sustainable direction. We're seeing a lot of movement right now around these corporate AGMs, annual general meetings. And what shareholders will do is, if we care about sustainability, we'll bring up these motions, right? We'll ask these questions of investors saying, hey, company, we want to push you on better disclosure or on say on pay, or we want to tie your CEO's compensation to climate change targets, something like that. And then all investors get to vote on those motions. So what's really cool is that even if there are some companies that kind of sneak into these doing less evil funds that you don't love, as long as the fund uses shareholder engagement, shareholder activism, you can sleep well at night knowing that your shares are pushing that company in the right direction. From there, we'll talk a little bit about green stocks. So when it comes to green stocks, this is where we invest in these themes. So these are like thematic funds. And there are a whole bunch of them, things like renewable energy, clean technology, sustainable development goals. The United Nations has these SDGs, these sustainable development goals. And there are now funds that track companies who sell goods and services aligned with those sustainable development goals. Now, these do tend to be a little bit more volatile, right? That here we're going out of our way to invest in green stocks, in things that are sort of doing more good. And, when I talk about this, because whenever I talk it to sustainable investors, a lot of them are like, Tim, I don't want to do less evil. I just want to put it all into green stocks. But that's not necessarily the best idea. And it's because these green stocks do tend to be a lot more volatile. And really to highlight this, because I think this is a big issue for a lot of people when I speak to them, I just want to throw up a couple charts here to show you what I mean by more volatility. So this is a chart I took today from Morningstar, which is a data provider, and that the blue line there is a very standard non-sustainable fund. XEQT. It's this global ETF portfolio. So it's going to be that mix of Canadian stocks, US stocks, and international stocks. So really you can see that blue line is the performance of the stock market over the last several years. And the orange line, well, that's ICLN. That's a clean energy ETF. And you can see just how volatile it's been, right? That in 2020, the whole stock market crashed with COVID, right? But then you can see green stocks shot up. And I want to talk about this a little bit because green stocks, I think, tend to be, investors and the share price performance might be driven a little bit more by emotions. That if you remember coming out of COVID, sustainability really was front and center. People very worried about climate change. And that it was sort of right around November of 2020 that we had the US election where Joe Biden won. And as soon as Joe Biden won the election, green stocks just popped. Like they just surged. Like I'm talking like doubled in value over a very short period of time. But once Biden got in, once he got inaugurated in early February, late January, early February, it was very clear within the first few months that he actually wasn't going to be the climate leader that so many of us hoped he was going to be, that the US wasn't going to move aggressively on climate change. And so you can see the share price of all these green energy stocks, specifically this renewable energy ETF, fell rather dramatically. Right? Now, had you invested back in 2019, you don't care about that. You wrote it up, you wrote it down. That's fine. You're still doing really well. You can see, as long as you've got a long-term horizon, you still sort of beat the market. But if you were sort of chasing the returns and if you invested sort of at that peak, I kind of have this as of, I believe it was sort of November 1st, 2021 and then into January, you can see that the green energy stocks have really outperformed over the last, year, whatever, 14, 16 months, right? And so if you became a sustainable investor and went all in on green stocks right at the peak, you would be really disappointed right now saying, hey, Tim, like I'm trying to do good in the world, green stocks, I think this is a good idea, but you bought at a really high point. And so this is why we want to be very deliberate when it comes to green stocks. I don't want you to put all of your money into green stocks. Instead, what we want to do is carve out part of your portfolio for these green stocks. I don't want you to put all your money in there. From there, the piece that I'm most excited about are these impact bonds, right? This is outside the stock market. This is where we loan money directly to nonprofits and co-ops in our community. So this is things like community bonds or, green bonds, or this building that I'm in, the Center for Social Innovation, that this is owned by a nonprofit. And how the heck does a nonprofit buy a building in downtown Toronto? Well, they did it using community bonds. And when it comes to these community bonds, there's a direct positive impact that investors in this bond help the nonprofit own this building. There's a direct impact there. And they also got very stable returns. That this is a bond. It doesn't move up and down. Even the bond market, things fluctuate a little bit. Investors in that bond earn a very stable return every single year. Now, of course, there is some risk here. You're loaning money to a nonprofit or to a co-op. We don't want to put all of your money into these types of things, but these impact bonds can be part of a really nice diversified portfolio, right? And we can carve out part of our pie chart for these types of green stocks and impact bonds, knowing that it's not exactly going to earn the same rates of return as a standard sort of traditional investment. That said, this is a way for sustainable investors to be able to invest according to their values and at least get some exposure and have some of that positive impact. Now, there are some critiques of sustainable investing, and this has been really interesting for me over the last few years because, when I started doing this a decade plus ago, nobody had any idea what I was talking about. And then all of a sudden, probably around 2020, right around when COVID hit, sustainable investing the interest in it just surged. That there was huge interest and huge flows of money into sustainable investing. And with that has come some critiques. And I don't want to shy away from them. I think it's important that we talk about these critiques to understand, are they valid or not? So the biggest critiques of sustainable investing is, number one, there are people that claim that it has no impact. Number two, people always assume that you're going to sacrifice financial returns, that you're not going to make as much money with sustainable investments. And, a critique that people have kind of thrown in my face lately is to say that sustainable investing is a distraction from other actions, that instead of a sustainable investing, we should be focused on things like pushing our governments in a more sustainable direction. So I want to take a couple minutes and just reply to these critiques right away. The first one, that in terms of impact, right? First of all, this idea of impact investing, these impact bonds, has a very tangible impact. That is not in question. That is not in doubt. By investing in things like community bonds or microfinance, you are directly funding these organizations, and the impact there can be measured and should be measured, and that we can see that tangible impact there. Now, when it comes to the stocks and when we have these sort of doing less evil funds, that what we see is that divestment and to a lesser degree ESG analysis has an impact on something called the cost of capital for corporations. So corporations, they need capital in order to grow. That's why they trade on the public market, to be able to access capital and to grow. And what we find is that with divestment, we've seen this, the cost to raise money, if a company wants to raise money to build a new, coal plant or a new pipeline or a new fossil fuel project, the cost for them to raise that money is way higher than it is for other companies. And so no doubt that when it comes to this idea of sustainable investing and specifically divestment, that there is this measurable impact on a company's cost of capital. It's not gonna, I'm not gonna change the world with my little, $50,000 RSP. I'm not gonna necessarily change the world, but collectively, as more people do this, it's gonna have a bigger and bigger impact on the cost of capital. And that the conversation is changing. And I really need to underline this point, that when it comes to sustainable investing, so much of what we're trying to do is to change the conversation around investing and what it means for companies to be able to maximize shareholder returns. And what we're seeing is that now every single company needs a climate plan. Every single company needs to do sustainability reporting, that investors, sustainable investors, by pushing the companies in this direction and demanding this, have changed the conversations that are happening at board level. Now, it's hard to measure this. I can't measure how much the conversation is changing, but it's very clear to me that across the entire economy, people are having this conversation about ESG, about sustainability. And the more people are doing sustainable investments, the more weight that is going to carry in terms of those conversations. So in my mind, there's no doubt that there is some impact with this. We can debate how much and is it enough to really change the capitalist system. I think there's a conversation to be had there. But for people that say there's no impact whatsoever, that's just complete BS. It's very clear to me that there is impact when it comes to this approach. From there, everyone automatically assumes, lower financial returns, right? So I want to address this again head on. And really what I've done here is done the performance of my model portfolios. So I've got 4 different model portfolios that I've got on my website. There's the organic couch potato portfolio. There's the de la creme, sort of the creme de la creme pie. I have the round the world pie, and I have my crunchy granola pie, which is sort of on the squeakier, clean side of the equation. Now, year to date, since January 1st, sustainable investments have underperformed. You can see the traditional benchmark. That's a very standard ETF portfolio. Sort of a traditional couch potato approach. And you can see that, the global stock market is down roughly about 6% since the start of the year. The organic couch potato, the round the world, and the crunchy granola are all down more than that. And that's understandable, that when we look at the last few months, the stock market has fallen, but the two things that have done better than anything else are military stocks and energy stocks, fossil fuels. Those are the things that have popped over the last few months, with the war in Ukraine, with the this quasi energy crisis, the price of oil going up. It's understandable that if we are divesting from weapons and fossil fuels, that our returns so far this year are lower than the benchmark. But when we start to look backwards and start to look from a longer term perspective, you can see that actual sustainable investments have done quite well. Now, 2021 was, again, a little bit of a tough year. Remember that green energy, it just did very, very poorly. So the de la creme, the round the world, and the crunchy granola pie on that doing more good, that green stocks are more on the renewable energy side of the equation. So you can see that did have an impact and they did have lower returns. But when we look at the returns from 2020, sustainable investments just absolutely popped. And even in 2019, before, we saw the big surge and then we saw the big decline in green stocks in 2021, 2019, the sustainable portfolios that I do have data for, if there's just a dash there, it's because the funds haven't been around long enough that I just don't have the data for those portfolios. But you can see that the returns, as we average it out over long term, that these sustainable investments have done just as well, if not even a little bit better than traditional portfolios. That said, I'm not going to promise that it's always going to be that way, right? We have seen so far this year, sustainable investments have underperformed, which, this is going to happen over certain time periods. That said, the financial returns, I think are very, very competitive when it comes to sustainable investing. And what's really cool for me is that, we can invest and get these solid financial returns and do it in a way that is aligned with our values. From there, the last sort of critique is this question of, is it a distraction? That, why do we do sustainable investing? We're just sort of rearranging the chairs on the Titanic, that type of thing. And, to really just be very clear about that argument, that number one, I want you to understand that investing comes with privilege. That if we have money to invest, hey, we're doing okay. Right. And obviously, the more money we have, the more privilege we have. And that, really, the more privilege we have, the more duty we have to be able to do these things intentionally and to really be able to invest in a way that is aligned with the world that we want to build. And that really what I love about sustainable investing is that oftentimes we only have to make the decision once. It's not like when you're going shopping and, every week you have to, buy choose what you're going to buy, what brand you're going to buy, these types of things where, you're making this decision over and over and over again. That when it comes to sustainable investing, it's pretty straightforward that we tend to make this decision once and then ride out that decision for the long term. And obviously there's flexibility. We can always change it. We can always switch things up, in the future. That said, it's hard for me to think that sustainable investing is a distraction when really it's a pretty focused decision that we're making that really, investors make once in their life. And then from there, just kind of ride that out for decades. The last step is that I really believe that diversity of tactics is important. And so this is my way of communicating that sustainable investing, it's not a silver bullet. It's not going to fix the problem. It's not like the one thing you can do and then you can relax. That it really is important that we use all types of different levers to be able to enact systems change. So just because we invest sustainably, we still need to be deliberate about the things that we're buying. We still need to be deliberate about our participation in democracy, to volunteer and to, go door knocking and get candidates elected that do reflect our values and that are going to push governments in this direction. So, to me, it's like, I think this idea of to say, sustainable investing is a distraction from other things that are potentially more important. To me, it's like, hey, I can chew gum and walk down the road at the same time. I can invest and still participate in democracy and still be a sustainable consumer and still volunteer for a nonprofit that, in order to have that local impact, that it's not meant to replace any of those tactics. Instead, I think it's a really nice way to enhance that. That if you're doing all of those things, but your investments are just kind of over to the side, disconnected from everything else, that to me is a huge problem that you need to think about. From there, really want to show the momentum that investors are catching on. So this is a chart that shows Canadian sustainable funds assets in billions of dollars. And you can see that in sort of 2017, it was a little under $10 billion here in Canada invested in these socially responsible and green mutual funds and ETFs. And then, the crash happened 2020, and then, whoa, you can see that surge. Such that there's now about $35 billion invested in Canadian socially responsible or sustainable mutual funds and ETFs. So to me, this is really exciting. Like, to see this amount of interest and the actual money flowing in is incredible. That said, we still have a long way to go. There's about $2 trillion invested in Canadian mutual funds and ETFs. And so to have 35 billion is awesome, right? But we're looking at, in the ballpark of probably around 2% of total money invested in mutual funds and ETFs are still invested in non-sustainable funds. There's still a long way to go. I still have a lot of work to do, right? And part of that work is helping people overcome the barriers. Like, why is there this disconnect? When I've seen surveys and things that show something like 3/4 of investors are interested in responsible investments, but it's like probably about 2% of assets. And I think, as I've talked to people over the years, there are a few things that have really popped up as some pretty big, I would say, emotional barriers when it comes to actually investing in a sustainable manner. Number one is that investing feels hard. It really is, this heavy weight for a lot of people. We don't learn basic investing in high school, right? So people don't know this. They don't understand it. It feels like a lot of work. We all have those same barriers. I have the same, reluctance to want to do my budget and pay my bills. And, I just don't want to think about it right now, right? And so I understand that, investing feels hard. And for a lot of people, it is easier just to kind of like keep it over there and not really think about it. As well, everyone is exhausted right now. We're just so tired and burned out. And especially, at this stage of a global pandemic, everyone is just so gosh darn tired that, it really is quite exhausting. And that I think a lot of people are scared to make a mistake. These are big decisions. This is your life savings. This is, potentially a lot of money that you're thinking about. And so I completely understand why people don't want to mess up and do the wrong thing, right? I really, really understand why that would be a barrier towards making a change like this. And so, what we've done here at Good Investing is figured out some solutions, some ways through those barriers. Number one is we make it fun and easy. When you work with us, you've seen my YouTubes and the different things that we do, really try to bring a positive energy to make it fun, to make it easy, to, make it hopefully enjoyable to learn about this stuff. As well, what we like to do is streamline the process. That really, for a lot of people, it's hard to figure out, where do I start? How do I do this? What are the steps we need to take? No problem. We've done it, hundreds of times, right? We've helped over 1,000 people figure this stuff out. So we've really streamlined the process to make it as easy as possible for you to do it. And really, we provide a second set of eyes that as you're doing this, there are some checks and balances to make sure that you're not messing it up, to make sure that, you are making smart decisions about how you invest your money. And that's really a lot of the work that we do is sort of being the little angel on your shoulder, that's making sure that you understand the risks, that we're not sort of, straying too far from that proven path. And that really, to hold your hand as people do it for the first time. Overwhelmingly, the reaction I get from clients when they've actually invested is like, wow, that was so easy. How come I didn't do this, years ago or decades ago, right? And really that's the hand holding that we do is we get people to that point where they do feel confident, where they do feel happy doing this. From there, most people are on a sort of investment journey, right? And we've developed a few different services for people at different stages of their investment journey. So if you're just getting started, if you're watching this and, maybe you just paid off your student loans and, you've got money to invest for the first time, or, you've just got maybe like $10,000 in an RSP or a TFSA, then really, the online course is where it's at. We made this very simple, very affordable, really easy for people who are just getting started to be able to learn the basics and get yourself set up with a sustainable investment portfolio. For people that are a little bit further along their investment journey, typically if people have more than $100,000 that they want to invest, that's when we offer custom planning, right? This is to help you manage the complexity. As you get more money, that's where you have to make these bigger decisions. And it's hard to be able to answer those things with an online course. That really what we want to do is work with you one-on-one to develop a custom plan to be able to talk about those complexities, right? And help you make the decisions that are best for your financial future. And then, we always offer hourly help, right? That really the model that we've got is that we're not brokers or managers. We never touch our clients' money. Instead, we're more like a coach or a consultant, right? And so we get paid by the hour to be able to help people. And, instead of getting a percentage of your money every single year, you can just hire us for an hour here or there if all you need is a little bit of help to get you through some of these barriers on your sustainable investment journey. So really, if you want to get started, if you've heard this and you're like, whoa, this is super cool, I want to learn more, we've made it really, really easy. Everyone gets a free consultation. So, if you want to sign up for a free consultation, you can just go to our website, goodinvesting.com, and you can book a meeting, and anyone, I don't care who you are, we'll sit down with you for 30 minutes, understand where you are in your investment journey, help you understand the options that you have ahead of you, and, kind of hold your hand as you sort of take that first step. From there, what we do is we figure out a game plan that, okay, where are you at? What are those steps forward? What are those paths? Really come up with that plan. And that realistically, it only takes about 4 to 5 hours to actually get this done. Again, psychologically, I think people are tired, they're exhausted. They feel like this is a monumental undertaking, trying to figure out how to invest my money or how to switch into sustainable investments. It can feel very intimidating, which is why, whether you're doing the online course or the custom plan, typically in 4 to 5 hours, we get you set up and you're good to go. So really that is the benefit of working with us here at Good Investing, is that we just streamline the whole process. And instead of, getting lost in the weeds, we can keep you on track. We'll be productive with our time and we'll make sure that you actually get it done. From there, if you want to learn more, I did host a podcast on this topic. So I partnered with the Toronto Star. The links are in the description below. So we did 18 episodes. So I think that's a really good place for people to start. If you listen to this and you're like, I just want to learn a little bit more, kind of dip your toe in the water and learn some of the vocabulary and the language. And a really good place is going to be that Responsible Investing podcast that I did with the Toronto Star. As well, there is this YouTube channel. So like this video, subscribe. We've done a bunch of videos and I'm going to be experimenting more with YouTube to be able to come out with more content and specifically targeted for people who are just getting started. I think it's really important to have that accessible content. And then, you can sign up for a free preview of our online course that, really you can follow the link, sign up for a free preview. That'll give you access to the first couple modules. It'll give you a feel for how we work, the style, the approach, and really, give some thought as to whether sustainable investing is right for you and whether you need a little bit of help with us here at Good Investing. That's it. Thank you so much for listening. I think I did pretty well. I'm looking at the time here, 7:30. I was aiming for half an hour. So I think I did pretty well when it comes to this presentation. So I really feel good about that. Would love feedback. If there are people that said, hey, I would have loved more information about this, or, you didn't really need to include that, by all means, throw it in the chat. I would love your feedback. If you're watching this after the fact, put it in the comments. I really am hoping to be able to get some feedback on this. So, thank you so much for watching. And I'm really happy. I see a couple questions in the chat. So what we can do is start getting into some of those Q&As. Awesome. So the first question is from, I think it's Gail. I hope I'm pronouncing that right. I'm trying to remember. There's someone named Gail and another Gail with the different things. I think this is Gail. Gail asks, do you know of something like USXF? But equal weight instead of market cap weighted. So yeah, there are some different equal weighted ETFs. In terms of the US market, I'd have to go through my database. I do have a little sort of Google sheet of the different US dollar ETFs. The one that comes to mind is CHGX. CHGX, it's the Change Finance large cap fossil fuel free ETF. And I know for a fact that one is equal weighted. So that would be sort of like the starting point. It's not exactly like USXF. There would be some slight differences that we might want to look at, because it's equal weighted, obviously less exposure to the bigger companies, but that would be a good starting point. And, happy to be able to go through my database to see if there are any more that are equal weighted. The other one that comes to mind is, I think it's ETHO. I'd want to double check that one, but I'm pretty confident that ETHO also uses an equal weighted methodology. Liz, I see your question here. Do you have examples of how investors make motions and have they passed at AGMs? Oh my goodness. This is such a good question, such an important one. And it's very timely because we are in sort of AGM season. A lot of the banks had it this week. I know there was a protest for Scotiabank. And as well, today there was supposed to be a big protest for RBC's AGM, and they actually canceled the in-person AGM. They made it virtual. They said that members of their team got COVID, so they needed to switch to virtual, which absolutely might be the case. We are in another wave of the pandemic here in Ontario, in Toronto. That said, I think they might have been looking at the protest at Scotia, and I think it was going to be an even bigger protest for RBC. And, they might have just decided that it's would be in their best interest to do it remotely. Anywho, in terms of motions and how that works, the best example that I have for a successful motion was at ExxonMobil's AGM last year. That Exxon, there was a sort of an activist investor. I think it was called like Engine Number One, I believe is what they were called. And they only owned a small percentage of Exxon stock, but they were able to get a motion at Exxon. And it was about electing new board members. So companies have these boards of directors and you vote on those board members before someone needs to get elected. And that they were able to get, I believe, 3 board seats with people who understand climate change and the climate transition. And that they were able to get those board seats at ExxonMobil, which is huge. And for the first time, that was really a tipping point, because for the first time, we did see groups like iShares and Vanguard and some of these big ETF providers that own huge percentages of these companies. And for the first time, they actually got involved and they voted for these new board members, which in the past, they've kind of always voted with management. And believe me, Exxon management did not want these board members. But, I think a lot of these companies realized that actually this wasn't the long-term best interest, that climate change risk is real. It makes sense to have some people on the board who understand it. So that's one example that comes to mind. I really think, I'd love to be able to dig a little bit deeper into this idea of shareholder engagement and, understanding these proxy voting guidelines. The organization that I really look to for this is called, here in Canada, is called SHARE, SHARE. I think share.org is their website, I think. And that really they're the Shareholder Alliance for Research and Education. And they do some incredible work in this area around these motions and proxy voting strategies. So maybe I can get someone from Share and do an interview with them or, something like that. I think this is a topic I'd love to explore if there is some interest on that. From there, I do see a question, and I see here, Liz, it was great. I'm so glad you enjoyed it. And Dwayne and Kay Carlson, thanks much. Excellent overview. I'm so glad that you enjoyed that. I've got here, it looks like potentially, I think a question from Matthew. I don't think it showed up on my screen, but I can see it in the chat on my end that what are my thoughts on green bonds? So green bonds are a really cool topic. And I actually I've got plans right now to make a YouTube video looking at different green bond ETFs, because I think green bonds are really cool. I think they're very interesting. I think it's a lot of fun. Here, I think I have to go to live chat. There we go. If I go to live chat, I don't know if, hopefully everyone will now be able to see all those different questions. But that when it comes to green bonds, really what we want to do is to be able to, these are bonds that do have, where the proceeds are used for green projects. So the federal government here in Canada just issued a $5 billion green bond, I think like a couple weeks ago. I had Daryl talking about it on our YouTube live, on our Q&A with Daryl a couple weeks ago. So, you can look at that video, and if you want a bit more of a detailed thought there. For me, green bonds, I think they're really powerful. I think they can be a really powerful mechanism, because I think it makes it easier for governments and corporations, again, to raise money for green projects. So this whole idea of the cost of capital, that if green bonds are popular and people want to buy them, then it's great, because what it means is that it incentivizes these companies and governments to raise money for green bonds and then use that for these green infrastructure projects. Great example is, here in Ontario, we did a green bond several years ago, and that's what's paying for the Eglinton Crosstown LRT, that light rail transit project that has been taking a long time to come to fruition. These things take a while, but once that's live, that's going to be huge in terms of letting people move across the city without the need for vehicles, right? Public transit, so important. How do we raise money for public transit? Well, what we need to do is do more green bonds. So it's pretty cool. Now, let me just see here. I think if I do live chat, there we go. Now people should be able to see all the questions. So that was Matthew's questions. Yeah, MG BlackRock, especially, for sure when it comes to this, absolutely. Here's Gail. Other than via government, is there a way to invest in intracity town transportation in Canada to decrease dependency on cars? Oh my goodness, Gail, I wish there was. Sadly, the only way to be able to do that would be to invest in companies that make things like buses and trains and streetcars, etc. For a little while, we had Bombardier, but they obviously haven't been doing well from a financial standpoint. They also make jets, including some military stuff. So to me, it's like it would be a little bit tricky, for me investing in Bombardier. They do this good stuff over here, but there might be some deal breakers over there. I can think of one company off the top of my head here in Canada, NFI Group. They used to be called New Flyer Industries, and they make electric buses. So, that may be a cool company to look at. That said, again, very dependent on government funding for these types of things. I don't really advocate investing in individual companies. I wish there was like a public transit ETF or something like that. Liz's point, the CMHC bonds for affordable housing, I just wish there was a way for us to be able to buy these types of impact bonds focused on affordable housing. The only option that I can think of is, in terms of affordable housing, there is a nonprofit here in Ontario called Indwell. If we go to my website in the research tab on the impact investment list, you're going to see Indwell. They are a religious organization that builds affordable housing projects in southwestern Ontario, which is super cool. I know they've got projects in Hamilton, and I know they just did one in London, I think it's the old Embassy Hotel where I used to see concerts. Like when I was a kid, it was a really rundown venue and hotel. They've now gutted that and are turning that into affordable housing units. So Indwell does have an investment option that you can loan them money for these projects. That said, it is a $25,000 minimum investment, which I know is a barrier for a lot of people. So I just really wish that there were these, cities and agencies and provinces that, I know so many of us want to support things like affordable housing. And I think we would love to be able to buy a bond, right, to still earn a small return on our investment, right, with that bond, but while also supporting the construction of affordable housing. I think that's a great idea. And that, I'm really kind of disappointed that when it comes to this federal green bond that, again, they just raised $5 million or $5 billion, which is great, but they raised it from institutional investors, that there wasn't a retail offering. That to me, I've always dreamed about the idea of being able to buy, a Government of Canada, Government of Ontario green bond, sort of like the old school victory bonds, like war bonds, when they were raising money for the war effort in World War II. You could buy a victory bond and know that that money was going to sort of, support the troops. Then in the same way, I would love to be able to buy a green bond or an affordable housing bond to be able to support the construction of those types of projects. In my community. Laughing Puppy asks here, do you have any thoughts on the Wealthsimple ETFs? So I do have a YouTube video where I did the Wealthsimple ETFs, not the new one. They've got a new green bond ETF that this would be part of the series, the video that I want to do on green bond ETFs. That said, I did do a review of the Wealthsimple publicly traded ETFs, WSRI and WSRD. The quick little thing on them is that they're good. They're not perfect. Nothing is. I did have some little issues with it. What I love about them is that the focus that they have on climate change, so climate leaders, and gender diversity on the board of directors, that they really have pushed the bar up in terms, I think companies need to have at least 3 women or 25% female representation on the board of directors in order to be eligible for those Wealthsimple ETFs. That said, they really hang their hat on those 2 issues, and they don't use a broader sort of ESG methodology. So they're not looking at, as many other indicators as I might want them to. So really interesting there. I did a deep dive on that. It might be time for an update. So maybe that's, I can start getting into doing ETF reviews again here on YouTube. I think that could be a lot of fun. But for now, I would really just point you to that video on the Wealthsimple review that I did. I think it was when they came out, when they updated it. It was probably a little more than a year ago. Liz is asking solar investment bonds. I wish that groups like Solar Share or some of these co-ops, Ontario or Ottawa Renewable Energy Cooperative, OREC, and these different groups, for a long time, Solar Share bonds were sort of like a staple of those impact investments. That said, because of the government change in Ontario, where they killed the feed-in tariff program, there just aren't new solar projects being built here in Ontario. So if there are no new projects being built, nobody needs to raise money for them. So I just haven't seen any real action there. So I wish there was. I love Solar Share. I would love for them to issue more bonds, but I think they're only going to issue more bonds if there are projects for them to fund. And since there aren't any new projects, there aren't any new bonds. So that's about it. Last chance for questions. If you can get it in there, if you have anything that's burning in your brain, please put it in the chat. Or, if you're watching this video after the fact, leave a comment. I'm more than happy to be able to, see those comments and be able to answer them in the chat. Otherwise, I do see another question here from Matthew. What can be done about a stock like Brookfield's that invests in both green and non-sustainable projects? Woo. So, Brookfield is a huge company. So if you invest in Brookfield Asset Management, bam, that's sort of the parent company, to my knowledge, that you're going to get the green stuff with the dirty stuff. That said, they have carved out their renewable energy division. So Brookfield Renewable Energy Partners. The ticker symbol for that one is BEP.UN, or BEPC is like the corporation. They've got kind of 2 different classes. They're basically the same type of thing. But that is Brookfield's renewable energy arm, carved out. So, you might want to look at the Brookfield Renewable Energy Partners. That said, last time I looked at it, there still was a little bit of natural gas in there. It was about 2% exposure to natural gas. Now, they might have gotten rid of that. That was a couple of years ago when I saw that, and it wouldn't surprise me if they made it 100% renewable because they were so gosh darn close. But, from there, really there are some companies that have a mix of renewables and natural gas. I'm thinking of like Northland Power, or Algonquin, Power and Utilities, where they are a mix of the green and non-sustainable. And you really can't separate them out. You kind of either have to like hold your nose and invest in the whole company, or, just find a different company that, if you look at those and you're just like, no, I don't want the unsustainable stuff. There are some companies that we would call pure plays. Utilities in that space would be things like, renewable or Intergex or Borlex, things like that. Okay, last question here, Gail, and wow, you've got a doozy. Oh, okay, I'm seeing a couple more questions. If you can get them in, get them in. I'll go for the full hour if there are questions. Gail asks, can you comment on the poor returns of bonds? Many people suggest full equity portfolio due to losing so much. That, yeah, if we had a time machine and I could go back, 6 months or a year, right, and invest 100% equity, okay, you might have done a little bit better. You would have missed out on a lot of those poor bond returns. The reason bonds are down so much is because we expect interest rates to go up substantially, right? And the expectations for interest rate rises keep going up. Right. So it's the type of thing where, really, whereas it looked like the interest rates were going to go up, maybe raise them a few times this year. Now I'm hearing estimates that interest rates might go up by as much as 2.5% by the end of the year. That the Bank of Canada has an announcement in April that normally if they wanted to raise them, they would bump it up by 0.25%, 0.25%. I'm hearing talk that they might raise it by 0.5%. Which is double what they would normally do. So what's happening is that because these expectations of interest rate increases are coming through, that the bond market reacts very quickly. So, really it's tricky. And keep in mind that if the expectations around interest rates going up continues and they think it's going to go up more than expected, which is what's happened over the last month, right, then bonds could continue to fall. That said, the idea that interest rates are going to go up by 2.5% this year, it's hard to imagine that they would go up by more than that, right? Could happen, but it's unlikely. And keep in mind, Gail, that with bonds, we're going to start collecting those higher interest payments. Now, obviously, if it's a shorter term bond fund, we'll start collecting those a little bit more quickly. For a longer term bond fund, it might take a little bit longer, right? And so it's the type of thing where, really when it comes to this, we do expect returns for bonds to go up in the coming years. All of this is to say that, I don't think it's necessarily a great idea to sell your bonds now because they've done poorly. Right? It could be that the worst is over and that we're going to start earning these higher yields going forward. That said, I don't have the crystal ball. I don't know for sure. Really, the downside of if you went 100% stocks, some people are saying bonds are useless. Get rid of them. I've lost money on bonds. They're terrible. I want to get rid of them. Well, now you have a lot of risk in your portfolio. And really, by getting rid of bonds, remember the goal that they play, which is that sort of stabilizing factor, right, within our portfolio. And if there is a stock market crash, you're going to be really glad that you do have bonds inside your portfolio. So I know it's been a terrible year for bonds, like terrible. I'm not going to defend it. Like it is what it is. Bonds are awful. We talked a little bit about this with Daryl a couple weeks ago, and that, certainly I think he's got more knowledge than I have on the fixed income side of the spectrum. But, really to me, it's like bonds are still part of a long-term portfolio. Absolutely. And even though they've done poorly, I don't think that's a reason to get rid of them. Right? Because to me, it's like understand the job that they're playing in the portfolio, which is to protect us in case there is a crash. Liz, I see your comment here. Bonds are fixed income category and are mostly better than bank interest. Surely there is room for some in a portfolio. And yeah, I think bonds play a really important part of your portfolio. The other alternative would be, to hang on to cash and to just earn that income. That said, the interest from bonds is higher than, the interest we can get from holding on to cash. That said, when we invest in bonds, the risk that we take is this duration risk that if interest rates go up, the value of our bonds fall. And it doesn't happen, when interest rates go up. The bonds fall when the expectation is that interest rates are going to go up, which is the environment that we're in right now, which is why bonds have fallen. So, the alternative would just be to sit on cash. That said, return interest rates at the bank right now are very low. We don't earn a good interest rate on our cash right now. So it really is, to choose maybe the lesser of evils there. Sadly right now, a lot of people are worried about the market, understandably, so they want low risk, but they also want high return. So, it's one of these things where we can't have both of those things. So if we do want to stabilize our portfolio, we do need either bonds or cash, which means that we do have to expect, fairly low returns right now. And really it's, there are some question marks there. The impact bonds, to me, this has been a great way. They have been stable. So Liz, to your point, if bonds are terrible, make sure the ones you invest in are contributing to societal needs, So this is why I think impact bonds do have a nice role to play inside of a diversified, sustainable portfolio. Certainly those have been more stable than bond ETFs. Eva asked me thoughts on ZooShare. So I'm not sure where ZooShare is. The last I heard, I know there have been delays and delays and delays and delays. I think that now project is under construction is what I'm hearing. I don't have an update. I would need to talk to my buddy Dan Bida, who started ZooShare, to be able to get an update from him. But I don't really have an or any information there, except to say that I don't think they're investing or accepting new investing. So I think it is just like if you've already got ZooShare bonds, you might just have to keep waiting. Unfortunately, they did run into some pretty big delays. MG commented, there's also a US and Canada clean tech ETF that goes by the symbol ACES. I think that one's pretty legit. Yeah, I've looked at ACES. It's fine. It does trade in US dollars. So, there are some currency exchange things. You might want to look at some of the Canadian dollar ones. There are some things that are similar to ACES, but that trade in Canadian dollars. But that's definitely one that was volatile, that it popped when Biden got elected and then it came down. I wouldn't say it crashed, but it dropped by quite a bit once Biden got inaugurated. And sadly, he had that whole Build Back Better bill where there was supposed to be, I think, like over $1 trillion for green infrastructure, and they couldn't get it passed. They couldn't get it through, which was just so sad when that happened. But obviously, again, when it comes to these green stocks, there are people, it is a little bit more of an emotional aspect that, people are playing with more the expectations, and it means that they can move a little bit more, bigger ups, bigger drops on news and expectations. And are we actually going to take climate change seriously or not? So awesome. Thank you so much. I'm going to wrap it up there. To be fair, that was pretty much the case with every clean tech ETF that I've seen. Yeah, exactly. I think that's it. That it really is, like that's been the story over the last little bit. Those of us who invested, years ago, that I've had shares since I think I started investing sort of 2017, 2018, that, hey, happy to ride out that wave. I've done well over that period of time. But I do feel bad for people who kind of like chased the hype. That, if you invested at the peak, then it just really sucks, because that's your first experience, and your first experience is it just falling quite considerably. So like with everything else in this, when it comes to investing, we want to take a long-term view. We don't want to try to, look at the crystal ball and guess what's going to happen and tweak things based on what we think is going to happen. Right? Instead, what we want to do is take a nice, calm, long-term view when it comes to this, and that these green stocks are more volatile, which we've definitely seen over the last couple of years, right? Which is why I want you to be deliberate about only carving out for part of your portfolio. So that's all I have tonight. Thank you so much for joining me. Super grateful. If you're watching this after the fact, please, if you've watched this long, give me a like and a subscribe. I'm almost at 1,000 subscribers. That's sort of my next goal. So, really grateful to everyone who already has hit that subscribe button. And if you haven't done it already, please, please, please do it. Very grateful for your time and your attention. I hope everybody has a wonderful week, and we'll see you here again for YouTube Live soon enough. All the best.